friends. Chris Marcus here with you for the StockPulse Network on Monday, October 1st. And an interesting article I wanted to share with you. It's incredibly relevant for where the economy is at today, especially with the Fed meeting last week. And today on CNBC, an article about the Fed could be hiking the US into a recession, warns Peter Boockvar. Interesting article. He mentions the Federal Reserve just keeps on hiking and it could be setting the economy up for the next recession. It mentions down here, we're now getting deeper into the rate hike cycle. And while we focus on where the Fed funds rate is going to be, behind the scenes, the Fed continues to shrink their balance sheet. Mentions the article, next month, the Fed will increase its reductions to $50 billion a month, 5 times the pace that was set this year, which is most certainly going to put pressure on the markets. We've seen that evidenced most clearly in the real estate market that has started to slow down. So far, nothing seems to be able to dent the ongoing stock rally here in the US, although again, you keep raising interest rates, and if the Fed does actually reduce its balance sheet, especially at a faster pace, that is going to put a lot of pressure. You're seeing it also in the emerging markets where now they're trying to repay the loans at higher interest rates. They're running into trouble. The United States government and Treasury is going to be running into that same problem as well, because remember, most of the debt is short-term borrowing. So as interest rates go up, that means the US debt expense is going to go up. So many things in here that I agree with Peter about, although perhaps maybe the one way I would phrase it, it's not necessarily, on one hand, yes, it is that the rates are going up and that's a problem. But what really was the problem is if you take a step back 10 years ago, before the rates went down, and now you have to raise them, that's what's created the problem. So you can't, well, I mean, I guess you can have rates at 0% inevitably, yet that destroys the currency. And of course, when you try to undo it, you run into the problems we're having now, which is why resorting to money printing as an economic balm is never advisable to do in the first place. So putting that in context, yes, the rates going up is the problem. That is going to be a problem. It's a tricky situation because now there is no easy way out. But again, interesting to see more and more folks, even in the mainstream media, coming on and warning about this, which again is why I focus on the resources and precious metals that are really the hedge against this. So interesting story. Take a look, leave your comments below, and love to hear what you think.